The end of the year is quickly approaching and I'm now busy evaluating what will be the best investment opportunities in the REIT space for the next year. Typically, I don't like to make one-year predictions because let's face it, anything can happen over such short time periods and I don't pretend to know how to time the market, but since so many of you keep asking me what are the best REITs to buy for 2025, I'm gonna try to answer that question in today's video. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and these are the REITs that I would buy for 2025 if I could only own 3 of them. Note that my company doesn't only invest in REITs, we also invest in REIT adjacent businesses like asset managers, as well as REIT-like entities that aren't officially structured as REITs, and I will include some of those in this list as well. And so with that in mind, the first company I want to discuss in this video is called Patria Investments. Its ticker symbol was PAX. This is an asset manager that's the leader in Latin America. It's essentially the Blackstone of Latin America. It's a major alternative asset manager with a wide portfolio of mostly private equity, real estate, infrastructure, as well as credit investments. And the reason why I consider this to be a REIT adjacent business is because the company has grown a very significant REIT asset management business. In fact, after its few last acquisitions, it has now become the biggest REIT asset manager in Latin America. What this means is that it is the external manager of several individual REITs, and so it provides asset management services for these REITs and it earns fee income in exchange of it. And rather than buying shares of these individual REITs that are managed by Patria, I prefer to buy shares of the asset manager Patria itself because I think that its risk to reward is somewhat superior. Its REIT business is earning fee income that's mostly based on the volume of assets under management, and today this volume is growing at a rapid pace as its individual REITs keep raising more equity, more debt to acquire additional properties, and Patria also structured additional new REITs. They are essentially following the footsteps of Blackstone, which is the biggest REIT asset management business in the US, and we have the benefits of insights to know today that this has been extraordinarily rewarding to the shareholders of Blackstone. We think that Patria is now set to replicate this in Latin America, and we expect similar strong results. Ever since the company went public, it has been able to grow its assets under management at a very rapid pace. This has led to over 20% annual growth in its fee-related income on a per-share basis. But the interesting thing is that despite that, its share price is today sitting at a near all-time low. As a result, its valuation has become exceptionally low, especially relative to its close peers like Blackstone, KKR, Carlyle, Blue Owl, and many others in the US. And we think that this is a great buying opportunity for 2025. Right now, the shares of the company are trading at roughly 8 times its fee-related income, adjusted for its accrued unrealized performance fees, and this multiple is about 2 to 3 times lower than that of its close peers. And from a fundamental perspective, I just don't think that this makes any sense because Patria is actually enjoying a faster growth rate than many of its close peers. It also has less leverage, a stronger balance sheet. In fact, it's expecting to be debt-free in 1 to 2 years from now. The company also has a stronger moat in its local region, which is less competitive than the US as an example. And so ultimately, we just think that there's a significant mismatch between the fundamentals of the company and its valuation, especially relative to its close peers. Recently, one of our analysts, Samuel Smith, has the chance to talk to the management team, and here's a quick recap from him.
Hey everyone, Samuel Smith here. I was recently able to interview Patria Investments, which is one of my top investment ideas of the moment. They're an asset manager that operates in Latin America. I was able to ask them some pretty pointed questions in the interview. One of the most interesting answers I got from them was regarding why their stock price has come down so much recently and why it is not a reflection of their underlying business. And this is really basically the fact that their fees that they generate are based on the net asset value, which is the private market value of the assets that they manage, not reflected by the current state of stock markets in the countries in which they operate. So for example, the Mexican stock market has been suffering recently due to a recent election that was quite violent and tumultuous, but their underlying businesses continue to hum right along, generate strong performance. In fact, they have $3.40 in net accrued performance fees currently embedded into their business model, which implies that they're exceeding their target return thresholds by a significant amount. And those $3.40 are over 25% of their current stock price, which indicates a massive margin of safety. Even not accounting for those, they trade at only 1/3 of what many of their peers in the alternative asset management space trade at currently, indicating massive upside potential for them. On top of that, management expects them to continue growing their fee-related earnings by about 20% for the next several years. So when you combine their margin of safety, their strong fundamentals, and their competitive positioning in Latin America, and their massive growth and upside potential, to me, it's a very, very attractive risk reward. I also talked about some other stuff, and I discussed Patria Investments more in a recent video that I posted. The link will be posted here in this video, so I hope to see you there. Thank you very much.
Thanks, Samuel. And by the way, if you want to check out his channel, it will be the first link in the description of this video. There we cover all our favorite non-REIT investment opportunities. So these are typically high-yielding stocks like MLPs, BDCs, closed-end funds, and so on. It's completely free, so make sure to check it out. It's the first link in the description of this video. To what Samuel just said, I just want to add one thing, and it is that Patria missed out on the recent rally of asset managers, and I think that this is the main reason why it's today so heavily discounted. If you look at most of its peers, like KKR as an example, or Blue Owl, they've seen their share price roughly double over the past year. They used to be also heavily discounted, just like Patria, but they now very strongly recovered because interest rates have started to go to lower levels. This is very bullish for the alternative investment field because this will lead to more capital going to these alternative investments, leading to growing fee income for these companies. But Patria somehow missed out on this rally, and I think that this is because it's not known to most investors yet. It's still a fairly new IPO. It's focusing on Latin America, which is today out of favor, and so it missed out on this rally. But I think that it's going to eventually enjoy a similar rally as its close peers in the US already have. And I think it's very reassuring to see how quickly these American asset managers recovered, because I think that we could enjoy something very similar in the case of Patria. And as it closes the gap to its close peers, it could see roughly 100% upside from here, or even more. And the nice thing is that while we wait, we're earning significant dividend income. Even right now, with its lowered payout ratio, it's yielding about 6%, and we actually expect a significant hike in its dividend income while it's done paying off the debt that it took to close its recent acquisitions. And I think that this ultimately could be the catalyst that leads to a strong rally in its share price, because today investors are disappointed that the company decided to retain more cash flow to pay off this debt. But once this is done and the company bumps up its dividend, perhaps even instates a new dividend policy that's clearer to investors, I think that this could be the catalyst that leads to significant upside potential. This could happen in 2025, and this is why I'm investing heavily in this specific company ahead of next year. Hey, before I go into the second company, can you please do me a huge favor and click the like button if you enjoy this type of content. Also subscribe to the channel. Thanks so much for your support. Then the second company that I want to cover on this list is called Canadian Net REIT. Its ticker symbol was NET.UN in Canada. And this is, in my opinion, the best net lease investment opportunity in today's market. You might have seen one of my many videos on realty income over the past years. I kept pitching in these videos two REITs specifically called Essential Properties Realty Trust and Agri Realty. Essential Properties Realty Trust used to be our biggest REIT holding. Well, it actually even is today still, but those have now very strongly recovered, and to the point that they are not particularly attractive anymore. They are not undervalued in my opinion. However, Canadian Net REIT mostly missed out on this recent rally, and as a result it still remains very heavily discounted. I'll put a table on the screen where it will compare its valuation to that of Agri Realty and Essential Properties Realty Trust. You'll see there that its valuation multiple is more than 2 times smaller today at this time. And just like in the case of Patria and its close peers like Blackstone, here again also it doesn't make sense from a fundamental perspective. Canadian Net REIT has historically actually been able to grow at a far faster pace than its close peers in the US, and that's because it's focusing on the Canadian market, which is far less competitive, and this results in stronger investment spreads for the REIT. I'll put a chart on the screen where you'll see its historic growth rates, and you'll see that this has actually been one of the most successful REITs of all time. In the decade ending with the pandemic, it actually more than 10x'd investors' capital because it was able to grow at such a rapid pace. And the interesting thing here is that I think that if the REIT can just regain a decent cost of capital, it could return to such rapid growth rate because there is very limited competition in Canada for net lease properties. Recently, I had the chance to talk with the CEO of the company. We posted an interview at High Yield Landlord, which is my REIT newsletter. By the way, I've made it free for everyone to read just for a few days. I removed the paywall, so if you want to check it out, it will be the second link in the description of the video. Also, make sure to subscribe to the free tier of our REIT newsletter if you don't want to miss out similar REIT CEO interviews in the future. We publish them quite regularly. There's one coming up soon with Gladstone Commercial and a few others as well, so make sure to subscribe. It's completely free. But the interesting highlight from this interview is that the CEO of Canadian Net REIT told us that their US peers are simply not coming to the US to compete with them because the transaction sizes in Canada are typically too small to move the needle for them, because as I've discussed in many of my previous videos, REITs like Realty Income are really big in size. They own over 50 billion worth of properties, and so buying a few individual net lease properties in Canada at 2 to 5 million a piece simply doesn't move the needle for them. They need very big portfolio transactions like they're doing in Europe today, and those move the needle for them. But those are not really available in Canada, and so they're simply not coming there. But the nice thing for Canadian Net REIT is that it's still very small in size, with a portfolio of roughly 200 million of assets under management. And so these small individual deals truly move the needle for them, and they're still very small. And so I think that they could keep up with this rapid growth rate for another decade or two to come. So why did it miss out on this recent rally? And I think that it's because it's a Canadian REIT, and the Canadian REIT market tends to react slower to macro changes like the changes in interest rates. And so we saw that in the US, that when interest rates were cut, rates rallied very significantly, but we haven't seen the same rally in Canada yet. And it's interesting because the Canadian central bank has actually been more aggressive in cutting rates than the Fed in the US. So this, again, from a fundamental perspective, this doesn't make sense. But anyways, I think that we're going to see a rally in Canada. It's just been somewhat delayed because Canadian REIT investors are not as active, not as fast in their reaction as American REIT investors. We think that this delay in market reaction is an opportunity for more sophisticated REIT investors, and eventually as Canadian Net REIT reprices for this lower interest rate environment, this lower inflation environment, I think that's going to reprice closer to 12 to 14 times FFO. That will still represent a pretty steep discount relative to its close peers in the US, which makes sense given that it's a smaller REIT with a bit more leverage. But in any case, this would result in over 50% upside from here. And while you wait, you're earning a monthly 6% dividend yield that's very well covered with a payout ratio in the low 60s. Again, it just doesn't make sense that REITs like EPRA Realty in the US have reacted so strongly to the cut in interest rates, but Canadian Net REIT has been left far behind, and I think that eventually it's going to catch up. It's a question of time, in my opinion, and therefore I really like to buy it ahead of 2025. And then the third REIT for this list is Camden Property Trust, ticker symbol CPT. This is one of the leading apartment REITs, and you know, if I could only own 3 REITs for 2025, I would want one of them to be an apartment REIT because they still trade at relatively low valuations. They've already risen quite a bit from their lowest points, but even today Camden Property Trust is still trading at an implied cap rate that's very close to 6%. It's in the high 5s, and I think that this implies that it's trading at a 20 to 25, 30% discount to its net asset value, which remains very attractive in my opinion, because I expect net asset values to start growing in 2025, 2026, and here are 2 reasons why. Well, firstly, interest rates are going to lower levels. The Fed already cut by 50 basis points. It's likely going to cut it now by 25 basis points many times going forwards. The debt market is pricing interest rates to return to the low 3s within a year from now. This is a very significant change in the market environment. I think that it will lead to lower cap rates for apartment communities like those owned by Camden Property Trust, lead to higher net asset values. And secondly, this cut in interest rate is especially powerful because it's going to happen right as rent growth is likely going to accelerate in 2025, 2026. The reason why I'm so confident in this acceleration in rent growth going forward is because the surge in interest rates of recent years put most new construction activity on halt. And so we had significant new development projects get started in 2021, 2022 when interest rates were very low. Today we are dealing with all of this supply hitting the market. There's some oversupply in some key regions of the US. It's leading to stagnating rents even for Camden Property Trust. But now this supply is going to dry up drastically in 2025 and especially in 2026 because, again, the surge in interest rates as well as the high inflation construction cost puts most new construction projects on halt, and less supply coming in but growing demand, especially in the Sunbelt markets of Camden Property Trust, combined together is going to lead to a much more favorable supply-demand dynamics. I think it will lead to rent growth, and again, if you had cut in interest rates combined with stronger rent growth, I think it's going to lead to cap rate compression, especially since cap rates did expand quite significantly in recent years. At the lowest point they were in the low 3s and now they are in the low 5s. I think that this is going to go back into the mid 4s likely, and with that the NAV of Camden Property Trust will expand quite significantly. It's also just going to deliver strong results simply from the cash flow it's earning, the growth that it's enjoying, and add to that some NAV expansion. I think you have a story for continued strong returns going forward, even despite the recent rally that it already had. I don't think that Camden has as much upside potential as Patria or Canadian Net REIT, but it's also a lot safer because owning these high quality apartment communities in rapidly growing Sunbelt markets, these are mostly Class B, it's recession resistant, it should benefit quite significantly from the cut in interest rates. This is a lower risk asset class and it has a very strong Class A- balance sheet, has significant liquidity, a blue chip track record, and so while it doesn't have as much upside potential, it's also a lot safer, and so I really like the risk to reward, and this is why Camden is one of the pillars of my REIT portfolio. Finally, if you want to access my entire real money REIT portfolio, you can do so by joining High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. It will give you immediate access to all of my holdings, all of my transactions in real time, all of my REITio interviews, all of my research in general. Again, completely free for the first 2 weeks. You don't pay anything if you cancel in the first 14 days. It will be the third link in the description of this video. Otherwise, once more, if you could please click the like button, that will help me a lot to keep producing all of this free content for you. Thanks so much, and see you at my next one. Bye-bye.